High yields put the market under pressure while investors wait to see if earnings justify valuations. Welcome to Market Insight. I'm Elena Casas. A sell-off in bonds pushed Treasury yields higher and forced down the most rate-sensitive stocks this Tuesday as the market dials back its expectations of how much the Fed might ease policy this year. That comes as earnings due this week and next are under pressure to justify high valuations. Joining me now to talk about all that is David Sekera, Chief Market Strategist at Morningstar. David, the market is going into this earnings season with, broadly speaking, very high valuations, but also generally lower third quarter guidance to meet. What are you expecting?
Yeah, I think third quarter earnings season is going to look pretty good overall. I mean, guidance should be pretty easy to meet or beat. The U.S. economy's done, much better than expected this past quarter. In fact, if you look at the Atlanta Fed GDP now, that's all the way up to 3.4%. That was as low as 2%, at the beginning of September. And then looking at, fourth quarter guidance, I would expect that should be at least within market expectations, if not better than expected as well. I think there's an upside risk, in the expectations here. We have very good economic momentum. We have the Fed easing. Just generally, I think we have more tailwinds from a macro perspective than, headwinds. And plus, we've also seen companies start cutting costs in advance of the rate of economic growth to start slowing this next quarter. So I think that's going to prop up and bolster operating margins here. So thus far, what we've seen is where we have seen stocks sell off. Generally, that's just because those individual stocks or stock valuations had gotten ahead of themselves. Looking at today's market action, I would highlight a couple here like Sherwin-Williams. That's a one-star rated stock coming into earnings. Logitech, Lockheed Martin, 3M, some other stocks that are trading down. Again, those have gotten ahead of themselves. Or conversely, there's also a couple stories where we think the market's getting it wrong. So for example, Verizon is a 4-star rated stock. We still think that stock is undervalued and has further upside left to go.
A lot of these high valuations have been driven by optimism over AI, where we've seen enormous capital expenditure. In the chip sector, we saw strong results from TSMC. But what are you expecting from US chip makers?
Yeah, we're still seeing a lot of ongoing bifurcation. So again, a lot of CapEx spending all going into the artificial intelligence stocks. But the traditional, the commodity, the more memory-oriented chips are still under a lot of pressure. As you noted, TSM results were very strong. In fact, they even gave strong sequential guidance for this next quarter. I think it was earlier in October, the NVIDIA CEO made some offhand comments, about Blackwell just being insane demand. So we're still in an environment where NVIDIA is seeing, too much, demand, not enough supply. They're able to charge, whatever they want for their chips. So I still think over the course of this quarter, we're going to see an ongoing trend where those traditional commodity-oriented chips remain under pressure. A lot of that is while the U.S. economy is doing pretty well, we do have a pretty weak economy in Europe and a pretty stagnant economy in China.
Is that bad news then for Texas Instruments that reports after the bell tonight?
Well, we shall see. We think Texas Instruments stock already is overvalued. It's a 2-star rated stock, trades at about a 13% premium to our fair value. So going into earnings, I think the greater risk here, is to the downside. And a lot of that is really just trying to understand what's going on with the bifurcation in the semi market. So for example, ASML guidance last week, indicated that CapEx spending was slowing specifically for, companies like Samsung and Intel. So the question really to me is that idiosyncratic just to Samsung and Intel, or is that really more indicative that CapEx spending is really slowing for all of the traditional and commodity-oriented semiconductors?
David, tomorrow's big tech headline is likely to be Tesla. It's the only one of the Magnificent Seven that has fallen year to date. Can it win back the doubters?
We shall see. Currently, the stock is rated 3 stars. Our fair value estimate is $200, per share. So one of the things that we're going to be watching this quarter is, whether or not they're going to be able to see an increase in their profit margins for their auto segment. Earlier this month, they announced third quarter deliveries of, I think, 463,000 vehicles. So that's a 6% year-over-year increase. So if we do see those profit margins start moving up, I do think that could be an upside catalyst for the stock. I will also be listening for any other commentary or maybe metrics that they provide regarding their full self-driving. If we see an increase in user adoption or miles driven, that also could drive the stock higher. Yeah, and lastly, really in my own mind, I think probably the next major potential catalyst is going to be if they give any updates on the new lower price vehicle that's set to start production, next year.
Thanks so much for that, David Sekera of Morningstar. And that's your market insight. Don't forget, you can watch more videos on Reuters.com.